Yes, good afternoon, good morning, depending on where you are, and welcome to our webinar today, Exxonmobil, a fight to the death, in which Neil Quach, our senior corporate research analyst for North America, will present his recent note in which he examines the consequences of the energy transition and its resultant technology revolution on the outlook for ExxonMobil's future. While the validity of climate change is debated by some, no one can escape the fact that the transition or the climate crisis has triggered a technology revolution in the way that we create energy, which poses significant product substitution threat to companies that rely on the outgoing technology for substantial parts of their earnings. And furthermore, while some may not or may agree with the climate science, others do, and are introducing policies that will likely accelerate that substitution rate significantly. My name is Simon Perham, head of investor outreach at Carbon Tracker. Carbon Tracker, many of you will know us, is an independent not-for-profit research house that converts climate science into financial risk and reward. Our mission, it's no secret, is to see an energy system that is sustainable to within close proximity to a 1.5 degrees warming scenario. This research, as well as our research on a whole, is free to download from our webinar. That's www.carbontracker.org, and is also available on the usual third-party platforms such as Bloomberg, FactSet, Thomson Reuters, and Capital IQ. Today, I'm joined by Neil, the author of the report. Neil has a CFA accreditation and significant sell and buy side experience. The format will be as follows. We hope to have a maximum runtime of about 50 minutes. Neil will spend the first 15 or so taking us through his 12 or so presentation slides, after which we hope to be able to answer any questions that you may have. The objective, I'm just turning over my notes to remember what I've got to say. The objective today is to deliver you the best practical advice and solutions as we can, as you consider your organization's outlook and approach to assessing Exxon's future. However, in order to achieve this, we're going to need your help, so please get your questions ready. Additionally, and lastly, before I hand over to Neil, we ask you that you do not submit your questions anonymously. Sometimes a great question comes up that requires a little bit more time to be answered properly, and which we will endeavour to follow up on a one-by-one basis after the webinar. So if you submit them anonymously, we are not able to do that. So that only leaves me to invite Neil to start the presentation, and thank you very much for joining us. Neil, over to you.
Great, Simon. Thank you so much for that introduction. Hey folks, my name is Neil Quach. I'm the Senior Corporate Research Analyst here at Carbon Tracker. I cover the North American oil and gas companies here. So today we're going to talk about ExxonMobil. Now, I wrote a report called ExxonMobil, the Existential Crisis. That report is available for free download at the Carbon Tracker website. And there are really 4 key themes which I outlined here in the agenda. So, let's get right into it. The first thing is transportation is the hallmark of a modern economy, right? Since the invention of automobiles, cars have become a crucial part of, generating economic activity. And for the past 150 years, oil has been the only automobile fuel source, the only practical automobile fuel source. So oil has, a transportation fuel monopoly, right? Now that monopoly is coming to an end. Now, the past 10 to 15 years have seen a dramatic decline in battery electric vehicle BEV prices. right? And BEVs are rapidly approaching parity with internal combustion engine, as you can see in the chart right here. ICE parity is about $100 per kilowatt hour. We're currently about 150, but we've been declining fairly precipitously. As a result, oil's transportation fuel monopoly is under siege. Now, it's not just battery electric vehicles. There's also renewable energy, right, which is wind and solar. They're now the lowest cost power source in the power stack. And, declining renewable energy prices, could lay siege to natural gas prices, right? But I think it's important to emphasize, well, first of all, how much demand is at risk, right? And this slide provides a granular breakdown of global, right? It's just global oil demand by end use. And, in terms of battery electric vehicles, the sectors, the end use sectors that are most vulnerable to that is the top two, the passenger vehicles and the medium and light commercial vehicles. And together they comprise about 35% of oil demand, those two sectors. Right now, there are other factors such as, heat pumps and, prospective improvements in battery energy density that could see other oil demand sectors at risk. So residential and commercial, which is basically space heating, right? And heavy commercial vehicles could also be at risk, right? So by my rough estimate, right, about 50% of oil demand is at risk just from declining, BEVs and renewable energy prices. And this is based just purely on economics alone, right? I'm ignoring for the moment the need to decarbonize, right? And in addition to volume, right? I think it's really important to focus on price as well. And this chart here shows current, oil prices versus other energy prices, right? Transportation fuel monopoly has kept oil prices lofty, right, compared to other energy sources. So losing this monopoly will exert downward pressure on oil price. So, I want to emphasize it's not just volume, but it's also price. Okay, and the final chart in this segment is a tale of two companies, right? Exxon obviously is an oil and gas company. Peabody Energy is a coal company. Now, these two companies have similar level of reserves on an energy equivalent basis, but Exxon's market cap is close to $500 billion, right? Whereas, it totally dwarfs Peabody's $4 billion by a factor of well over 100 times. And that valuation gap, that's been enduring. It's been going on for a pretty long time. And at the risk of oversimplifying, right, the key reason for that disparity is oil's monopoly as a transportation fuel, which I outlined earlier, I believe is coming to an end. Okay, so yeah, I mean, that's a transportation fuel monopoly, right? The next thing I want to talk about is a thing called duration mismatch, right? First of all, Exxon is pursuing production growth. Currently, they're targeting 3% production growth per annum. And, their production growth is really coming from four, basins, areas. It's Guyana, there's Permian Shale, there's offshore Brazil, and there's LNG, right? So, back to duration matching. Duration matching basically means, matching future oil and gas supply to prospective future oil and gas demand, right? And, obviously the risk of duration mismatch is poignantly demonstrated, from banks in the current financial crisis. Now, Exxon is conducting, frontier exploratory activities, and they're investing in greenfield projects, right? And due to the long cycle times of these activities, the company runs the distinct risk of producing a product that nobody needs, which we at Carbon Tracker, we've coined a phrase for it. It's called stranded assets, right? And we would argue that unconventional shale, such as the Permian Basin, is a better investment than conventional, right? Because shale has a shorter duration, thereby lessening stranded asset risk. And the two charts here basically are illustrative, if you will, price curves, type curves, right? And what I show here is that 80% of the revenue from a shale well, right, comes within 4 years, whereas it would take 20 years for the same thing for a conventional well. So shale, particularly the high return Permian Basin, which Exxon is involved in, can meet short-term energy needs, right, while reducing stranded asset risk. And for Exxon, 15% of Exxon's production is from the Permian Shale. Right, so that's duration matching. So the next topic I want to talk about is the low-cost producer, right? And basically, in a sort of Paris-aligned IEA net zero emissions scenario, right, there's a residual 25 million barrels per day of oil demand left by 2050, right? And that compares, to put in perspective, we're consuming about 100 today. Now, whether or not you believe in the IEA's NZE, that's what they're calling for, okay? So the thought is the low-cost producer will capture that 25, right? And the conventional view is the low-cost producers are the Saudi Arabias of the world. I think everybody's familiar with the Saudis' legendary low production costs, But Saudi Arabia has other costs associated with its oil production. And by that, I mean there's social spending that the government engages in, the absence of which will result in significant civil unrest and instability in the kingdom's oil supply, right? So my view is the Saudis' costs are actually higher than what it looks like on the surface. So it's not outside the realm of reasoning for Exxon to be that low-cost producer, right? But it's got to focus on keeping a lid on costs. And I think as a corollary to that, right, it's sort of got to shift away from an emphasis on production growth. Okay, so that's my low-cost producer thesis, right? So the next thing is it's not all sunshines and rainbows in the energy transition. That pun is fully intended, right? There are challenges with BEVs and renewable energy, which includes the intermittency of wind and solar and the low energy density of batteries, right? And this is where, at least partly Exxon's low carbon solution business, or LCS, comes in. Now, LCS involves basically three technologies. It's carbon capture and sequestration, there's blue hydrogen, and there's biofuels, right? Carbon capture and sequestration, or CCS, in the US could hold promise. They've been doing CCS via enhanced oil recovery in the US for over 5 decades right now. Also, the US Inflation Reduction Act, or IRA, they call it IRA in Europe for I think obvious reasons, has generous subsidies of $85 per ton. And that could place many CCS applications within reach of the IRA subsidies. And that's kind of shown in the left chart over here. Right? So IRA is a game changer for CCS in my view. I would also point out that CCS, it appears to work in the right economic, with the right economic incentives. For instance, when it's sort of paired with EOR, enhanced oil recovery, it seems to work. Okay. Now over to the second technology, hydrogen. Right. Now hydrogen is a very versatile fuel, right? And it also is a dense energy carrier. Now Exxon was initially they were focusing on blue hydrogen, and blue hydrogen is basically hydrogen produced from steam methane reforming. It's a refinery process, right, paired with CCS. The other technology, that's blue hydrogen. The other technology is green hydrogen, and that's basically hydrogen produced from solar and wind. Now, I'm skeptical about blue hydrogen. The IRA, right, it substantially favors green hydrogen over blue hydrogen. Also, green hydrogen is undergoing secular cost declines due to economies of scale, right? And blue hydrogen could be environmentally flawed, right? But to its credit, Exxon, it appears to be warming up to blue hydrogen, or rather green hydrogen recently. So it looks like it's going to take a dual sort of blue hydrogen, green hydrogen approach to its strategy. And the third technology is biofuels. And biofuels, look, it's really the only viable alternative fuel source for certain hard to abate applications such as aviation. But for biofuels, a sustainable feedstock is crucial for its long-term viability. We should avoid impinging on food supplies to meet our fuel needs, in our view. And within biofuels, there's this thing called renewable diesel, which Exxon is involved in, right? Which can use a diverse array of feedstocks, including used cooking oil. So that's LCS. But overall, with LCS, I don't think it's going to be a material part of Exxon's business for now. Exxon, they're only spending about 10 to 15% of their capex on LCS. And while the IRA is a significant legislation, right? By my assessment, I think we're going to need more regulatory support, perhaps a carbon tax or a cap and trade on a global level for LCS to really reach escape velocity. So sort of the last slide here is, these are sort of the four key takeaways I want to kind of leave you guys with. But I want to hear from you guys. So, let's, Simon, if you can just open up the floor for questions.
Yeah, great. Okay, thanks, Neil. And if I may just remind everybody to put your questions into the Q&A function, and please, again, don't do them anonymously, because if we don't get around to them, we will come back to you afterwards on a one-to-one basis. Neil, first one's from Peter, who's in the US, and he says, you focus your examples on oil demand at risk, but as we know, Exxon, after all, is an oil and gas company. What about natural gas? What's likely to happen there?
Apologize. Yes. Yeah, it's an excellent question, Peter. And natural gas is sort of they have the other meat, right? Like pork is the other white meat. Natural gas is the other hydrocarbon, right? And 60% of Exxon's production is oil. The other 40% is natural gas, right? So natural gas is very important. And I have a slide in the appendix here. Yeah, here it is. So, that the right part of that slide provides a breakout of natural gas demand by end use, right? And within natural gas, about 40% of natural gas demand is from power. That could come under siege from low cost renewable energy, right? With the usual caveat that we will still need to find solutions for the intermittency problem. The wind doesn't always blow, the sun doesn't always shine issue, right? But it's worth mentioning, and Carbon Tracker has done some research on this. We are seeing renewable penetration rates consistently surpass prior expectations. Okay. The other kind of thing the other end use to worth highlighting here is that 20% of natural gas demand is from what this is, by the way, this is the IEA numbers, is what the IEA calls building, and this is basically space heating. And that could come under siege from heat pumps, right? So you have 40% from power, 20% from space heating. So 60% is at risk, with the other sectors potentially facing varying degrees of risk. So yeah, I mean, that's what I got to say about natural gas.
Okay, so this one comes from Callum, and he says it's a slightly adjacent question, but I'll read it out for you. I've read about the possibility of oil and gas firms potentially focusing on low emission intensity oil grades, i.e. heavy crude 200 kilogram CO2 versus sweet cute 45 CO2 per barrel, kilogram per CO2 per barrel. However, firms like Gallup have focused on sweet crude reserves but have not been rewarded. Is this idea a red herring for markets in your view?
Yeah, I think the issue with I think what you're referring to is scope 1 and scope 2 emissions, right? And the issue with oil and gas, obviously the elephant in the room is scope 3 emissions, right? So 80 to 90% of your emissions from the combustion of oil and gas, or the ultimate total emissions, is derived from scope 3, right? Now I do believe that low emission fuel source, low scope 1 and scope 3 fuel source is a start, right? It is a start. And light oil does have lower emissions, both scope 1 and scope 2 as well as scope 3, right? But it still emits a lot of CO2. Right, so I think we got to really look at the elephant in the room. It's scope 3, and it's not necessarily that I'm not going to get into the debate as to who's responsible for scope 3, right? But if you're an oil and gas producer, ultimately, right, your production will impinge on the scope 3 question, because by the nature, by the fact that 80 to 90% of your emission is scope 3, right? So I mean, that's kind of the way I see that. Right? I think it's important to focus on scope 1 and scope 2, but there's always that elephant in the room, right? Scope 3.
Okay, quite a number of questions coming in. Neil, this one's from Ellen, and she's in Canada. She asks, Exxon said this month its LCS business could be as large as its base business. Your report implies otherwise. Can you dig into a little bit more detail as to why you think that? And there's a follow-up question from Leah, and also hopefully it's Leah, and also from Christina in Germany about the IRA. But let's take the first one from Ellen. Can the LCMSB business be as large as the base business or not?
Yeah, that's actually an excellent question. All right. So in my view, it's hard to envision a scenario where LCS replaces traditional fossil fuel business for Exxon. And this is just due to the sheer size of traditional oil and gas business. Now, the oil and gas industry globally in aggregate is a $6 trillion a year business, right? Depending on what oil and gas price assumptions you use, right? Now, this is a very large number. In fact, if oil and gas were its own nation state, it would be the third largest economy in the world behind the United States and China. So, fossil fuel is a big business, right? And Exxon is only spending about 10 to 15% of its capex on LCS. So to replace traditional oil and gas with LCS, in my view, is a bit of a stretch. Now, Exxon is moving aggressively on LCS front, but again, you're starting from a very small base. So it's got a lot to build, right? Can we get there? Yeah, but it's got to be sometime in the distant future, and we're going to need I think a radical change in the carbon pricing regime. So yeah, that's what I have to say about LCS.
Okay, so and quickly, John has just added a question before we perhaps go on to the IRA part of the question. In your 10 to 15% figure, are you including the spending the company is doing to reduce its own emissions as part of your LCS spending percentage?
Yeah, that's right. About, of that $17 billion of spending, again, it's 10 to 15% of Exxon's capex. By the way, that $17 billion is from 2022 to 2027, right? It's not an annual spending, but it's over that period, and it's escalatory, right? So initially it's going to start small, but it's going to build up. About $10 billion of that $17 billion is going to go toward reducing Exxon's own emissions, okay? The other $7 billion is going to go toward reducing other people's emissions, okay? So that's kind of how they're going to break it up. But yeah. I mean, I hope that answered the question. I'm not sure how IRA will necessarily come into that, but I hope that answers.
Well, the question that we have here, Christina asks, do you have any thoughts on the effect of the IRA on Exxonmobil? Will it accelerate the substitution away from Exxon's traditional business? But at the same time, will it accelerate, Exxon's LCS business is enough to offset that? And Leah, so that's kind of like part one. But and Leah's, apologies if I'm getting that wrong. How impactful do you think the IRA, or IRA as we have to call it over here, will be on accelerating green hydrogen capex investment for Exxon? Any thoughts on those two issues?
Yeah, I think the IRA is a very significant legislation, right? It is incredibly hard to understate that fact. Okay, will it accelerate investment? Yes, and it already has, right? So Exxon announced a project recently with Linde Industries. It's a CCS project. They're basically going to take Linde's emissions and inject it into the underground, right? So, and they said that IRA is very significant, okay? And in my view, there's no doubt that IRA is very significant for the LCS business, right? Will it accelerate the move away from traditional? Yeah, but again, we're talking about the scales here, right? $6 trillion a year business versus a business now is, at most maybe tens of billions of dollars at most, right? Now IRA, I mentioned in my slide presentation, which I have up on the screen here, the IRA has a Section 45Q. It's a CCS tax credit. Section 45Q is CCS tax credit of $85 a ton, right? And this chart here basically shows that there are a lot of point source emissions are within that $85 a ton credit. All right, so this, IRA will significantly spur CCS investment. But more important, I think on the green hydrogen front, right? I mentioned in my talking points that green hydrogen, the IRA substantially favors green hydrogen, especially over blue hydrogen. There are certain instances where the IRA, like there's called Section 45V tax credits, right? They're going to bring your green hydrogen cost down to zero. Okay, it'll cost you nothing to make green hydrogen. All right, so IRA is very, very significant. I think that's also important that Exxon appears to be warming up to green hydrogen because they were only focused on blue hydrogen before. And, that blue hydrogen just has some issues with that. And I think, green hydrogen, the IRA will be significant in spurring, a hydrogen economy in my view. It's going to totally change the landscape of the industry, 5-10 years down, from today. So yeah, that's.
Okay, so we're going to change tack a little bit here, Neil. Ian from somewhere in the UK has asked that the report suggests that companies that have a larger shale exposure may well benefit by being able to better match supply generation to forecasted, demand duration, if you like. Now, I know that this is something that Carbon Tracker has suggested before in its report managing peak oil in 2022. But the question is, which other companies have a large shale exposure that perhaps investors might like to, look at in terms of, either adding to their portfolio or investigating whether they should?
Yeah, first of all, another excellent question. And I think, by the way, I think it's correct to kind of emphasize the Permian. There are other shale basins, there's Bakken, Eagle Ford, and so forth. But it's, the Permian is really the premier high return shale basin today, right? And among the big US three, right? I call it the big three. It's Exxon, Chevron, and ConocoPhillips. Together, they comprise close to 50% of the aggregate market cap of the oil and gas sector. Exxon, I mentioned in my prepared remarks that 15% of their production is from the Permian shale, right? For Chevron, it's 25%. For Conoco, it's 30%. So Conoco has 30% of its production in the Permian shale. Now, there are other Permian levered names as well. You have Occidental, they're about 45% in the Permian. Pioneer, which is a Permian pure play, so they're 100% Permian. You have Devon, you have Diamondback. I may be missing some other names here. There's some smaller names that have Permian exposure, but those are, if you're focused on the really large cap, I mean, those are the names that I would highlight.
Okay. All right. Thank you. Okay. Now here's one that we often get, Neil, at Carbon Tracker, and it's the old metal and minerals required for the transition, and the concern over availability. So often, and it's from Rachel in the US, and she said, and I know perhaps the US is debating this a lot more at the moment. Often cited concern is the availability of the metals and minerals required for the transition. Do you share the concern over the availability, or what is your views?
Yeah, the IEA in a sort of landmark 2020 report on critical minerals and the energy transition is called the role of critical minerals in the energy transition creatively. Yeah, so they say, quote, there is no shortage of resources, right? Essentially, they're saying that, they're finding their economic viable resources are growing despite, continued demand growth, right? And it's also worth mentioning that, one of the characteristics of oil and gas, and by the way, this is great if you're an oil and gas producer, right, is once you use the oil and gas, it's gone, right? With metals in the electric vehicles, after you use it, you can recycle it. Right now, admittedly, that's being somewhat facetious, right? The impact of recycling will be limited in the short term, right? But the challenges of minerals, in my view, are different from the challenges in hydrocarbon. So yeah, I mean, that's what I have to say about minerals demand.
Yeah, and just to add to that, certainly something that I've read recently, Neil, was that effectively hydrocarbons and fossil fuels are a storage of energy, and one of the huge advantages of the new system is that we're moving from burning hydrocarbons to store energy to chemistries, and as we know from the periodic table, the exchange of electrons can be done by numerous chemistries, and we're seeing that in the sort of number of different technologies in solar panels, from the first generation to the third, and obviously the number of chemistries in batteries that are now being investigated and scaled up. But so yeah, absolutely. A question here about really again, going back to the 45Q for CCS, and I think it's from James, and he asks if many companies continue to use the 45Q for CCS, what will the cost to the taxpayer be, and how much of it will go to corporate profits? There's a political question for you. Any thoughts?
Yeah, honestly, I'm not a politician. I'm a boring economist. So, but I'll try to talk around that. The point is, it's, some of these tax credits are pretty significant. All right. I mean, if anything, it's spurring these, these low carbon technology. So, I mean, that's a good thing, right? How much it will take? I mean, there are certain credits like the Section 45V credits for green hydrogen, right? Where effectively your hydrogen costs you nothing, right? I mean, I thought that through. I mean, that's just going to cause, these subsidies to skyrocket, right? So yeah, I mean, it's going to be significant. I think it'll probably end up, probably spending more than what the Congressional Budget Office is currently forecasting. And yeah, I think it will be significant. Yeah, I think it will be significant.
And on the sort of follow up to that, Kate is asking, the IRA is, I think, was it 8 years? It's just 8 years long. What's the danger that we get these investments in these technologies like green hydrogen, and by the time the IRA subsidies sort of fall out, these technologies are still not competitive enough to compete with the incumbents, and suddenly you've built this green hydrogen plant or whatever, and you're left with an asset that's not competitive. What's the danger of that, or is there a danger?
Yeah, absolutely. There's absolutely a danger. And, obviously, if you're going to invest in an oil and gas project, or any project for that matter, you run an NPV analysis, and the NPV analysis doesn't end after 2033, right? When these IRA subsidies expire. So, yeah, I mean, that's a totally correct question, right? But, I mean, the way I see the IRA is that, you have, CCS, hydrogen. I mean, they're relatively immature technologies. I mean, they're mature from a scientific standpoint, but from an economic penetration standpoint, they're relatively immature, right? And there's this thing called Wright's law, right, where your cumulative experiences results in a precipitous fall in the price of anything you produce, right? And we saw Wright's law dramatically demonstrated with solar panels, right, where in the past 10 years we've seen a tenfold drop, right, in solar panel prices because of Wright's law. And I think what the IRA will do is it'll spur, that the building up of economies of scale and a Wright's law phenomena, happening within hydrogen and CCS, right? So, I think you're absolutely right in saying that, we got to look past 2033. It's also a question, there might be some legislative relay going on there. Are they going to extend it? Is it going to be a Republican or a Democratic administration that's going to be around during that time? Yeah, I mean, those are valid questions, but I'm actually pretty optimistic that the industry will be able to reduce costs, right? And come 2033, it'll be an entirely different landscape than it is today, because you're starting off with an industry which is at ground level, and they're building the economies of scale, which will ultimately reduce their costs.
Okay. Slightly on a different strain here, Manny has asked, what is the geographical angle to Exxon's transition strategy, i.e. its growth outlooks in South Asia are typically higher than North America and Europe. Does Exxon, when it is looking at its transition strategy, make an allowance for these, these different rates of growth? Where does it see the most growth? Is it exposed to that growth, or is it just geographically, has it got to geographically move to take advantage of those different growth rates?
Yeah, I mean, first of all, oil and gas is perceived as a global commodity, or, let me rephrase that. Oil is generally perceived as a globally fungible commodity, right? Natural gas less so for obvious physical reasons, right? Now, yeah, I mean, do they need to relocate? I mean, ultimately, they're going to produce where they're going to get the lowest cost, right? And one of the lowest costs is probably right now is shale in the United States. Okay, and in order to get that, in order to turn that shale into a global market, you're going to need liquefaction terminals, right? LNG essentially, and you got to build out that infrastructure, right? So, do they need to invest more in Asia? No, I mean, ultimately, I think the imperative more is to find the lowest cost basin around the world and then build up the infrastructure to get that lower cost, to basically take advantage of that arbitrage, if you will. So
Okay.
I think that answered the question. I hope I did.
Okay. And just going on to you talked about when you and the question here really has come out of another question, is that a lot of people think that analysing companies from an ESG point of view, somehow we've got to reinvent, or analysts and the financial community have to reinvent the way that they go about analysing a company for a sustainable sort of future, etc. But am I right in thinking that what your report is actually really just boiling down to is that it's the good old substitution effect, and it's about forecasting how quickly demand will be substituted by a new and aggressive system that is coming in at speed. Is that the general message that you are giving, i.e. that no, you don't have to look at a company differently in the energy transition? This is just a good old-fashioned incumbent technology that is being usurped by a better, fast-growing technologies. Are we right?
Yeah, I think that's right. Yeah, I think that's right. The phrase I would use, though, is the transportation fuel monopoly under siege, though, right? I wouldn't just call it substitution, because it's a deeply profound thing, right? That this transportation fuel monopoly, which has allowed oil to trade at significant premiums, right? It's allowed basically oil and gas to be a $6 trillion industry, right? The third largest economy in the world is oil and gas, right? And a big part of that is transportation fuel monopoly, right? So I want to say it's not just substitution, because that kind of underplays the real profound significance of the change that's going on today, right? It's this loss of transportation fuel monopoly, and it's hard to understand how important transportation is, right? I mean, most of the people, here, like, probably commute by cars, and cars are very important for generating any unit of economic activity in any economy around the world, right? So it's very important that you're losing that transportation fuel monopoly. But I do agree with you, a big part of that is substitution, but I wouldn't say it's substitution. I would say more it's transportation fuel monopoly under siege.
Okay. And this one, we've got a question from Nori, and Nori, I will simply say that is a big question, and I'm not quite sure. And I think what I'd like to perhaps suggest is that Neil, gets in touch with you after the webinar, and perhaps you can take that discussion further. But I will read it out just so everybody knows. From a financial modelling perspective, how would the IRA be factored in for future cash flows, and what would the expected investment for Exxonmobil, what is the expected investment for Exxonmobil to benefit from it? I don't know whether you've got a couple of just initial comments, Neil, or we might just take that one offline. Any initial thoughts?
Yeah, I mean, I would say, this is an industry that's very early days, right? So you got the three technologies: CCS, hydrogen, biofuels, right? We sort of know what the returns are in the biofuels business, but in terms of CCS and hydrogen, it's really hard to pin a number on that, right? And it's all really dependent on your assumptions, because these things are going to grow. They're exponential growth models, right? So a change in the rate from 3% to 3.5% makes a huge difference to your NPV, right? So it's and I mean, the other issue is that we at Carbon Tracker, we're not technically an investment advisor, so we're not allowed to really give really concrete valuation numbers. But I mean, hopefully I can provide some color around it. The European Union carbon price right now about $100 a ton, right? Exxon, they're targeting $20 million a ton of CCS, right? And that's just CCS, right? I mean, there's other businesses as well which you can sort of model, right? But 20 million tons of CCS, they're targeting $100. That's $200 million business. Exxon has revenues of close to $500 billion, right? So that kind of puts it in perspective. Now, bear in mind, those are very short-term targets, and this business will experience exponential growth, right? So it really depends on right now. I mean, when you're looking at an industry like this, and I've looked at growth industries before, your analysis depends on really small changes in your assumptions, right? So you really have to kind of look at it from a more subjective standpoint, right? So yeah, I mean that's what I would say about it, and I'll be glad to answer any follow-up questions you may have when we after this talk.
Yeah, and just on that, we know in discount cash flow models, often the terminal value is a very significant sort of portion of the value that is derived from the DCF. Given that
totally.
actually you're talking about a duration mismatch, is that likely to the fact that your view is that the incumbent system is not likely to be around, certainly not in the same size as it has been, is that likely to have a much more significant effect on the way that we model and these companies than tweaking around the edges on discount? The fact that the terminal value you are assuming or implying in your presentation, the terminal value is going to be a much shorter period. Any quick thoughts on that?
Yeah, I mean, the thing I would say is, it's the old adage, right? That, a good company is not a good investment, and vice versa, a bad company is not a bad investment, right? So, I mean, ultimately it's, you got the terminal value, and then you got the whatever the company's trading at today, right? So, but in terms of terminal value, can it go to zero? Listen, the energy transition is not going to be a smooth progression, right? It's going to be messy, right? And, you're dealing with so many different assumptions that, again, it's a very subjective analysis, right? I mean, anybody who tells you, look, I know exactly what the energy transition is going to do, it's like, well, if you do, then why don't you put your money in the market, right? It's very hard, but it's a deeply profound issue, right? This energy transition actually, is probably, I've been in this industry for 30 years, it's probably the most exciting time in the industry, right? Even though, we can see a sunset of the oil and gas business, because, it's totally transforming this whole energy business, this whole energy sector in a way that, we haven't seen in like 150 years. So, it's important. It's going to be hard to come. We're very early days into this, right? And a lot of it is going to depend on, policy, depends on the relations between the United States and China and Europe. And, it's going to be a bunch of factors that are kind of, beyond my pay grade, if you will, right? But, I mean, there are going to be factors that out there that, you really got to look at, and you got to sort of, like the IRA, once the legislation came out, I was putting pencil on paper and trying to figure out what the ultimate impact is going to be, right? You got to look at all these legislations and just try to come up with some firm numbers, right? But that's sort of the way I see it. Yeah.
Okay, and we're coming to the sort of 50-minute mark, and I just want to throw another question at you, and it's bringing up a little bit of the point that you made earlier, that you felt that CCS as a technology may actually work, but it's and we're not here to sort of pass judgment on that, but you intimated that the business model of CCS is probably the thing that's going to be the problem. Did I hear that right? And if so, can you just expand a little bit on that?
Yeah, totally. I didn't say CCS would be a problem. I actually think, CCS is a promising technology, right? And,
But
the US.
the business model you mentioned, and I might have heard you wrong, but
Yeah. I mean, that's actually a good point because, because it's such a new technology, it's easy to get confused with the terms, right? Now, what I said would be at risk, right? So you have three business, CCS, hydrogen, and biofuels, right? What I say could be at risk is hydrogen, but specifically blue hydrogen. Now, blue hydrogen is, hydrogen using a refinery process paired with CCS, right? So I'm not saying that, CCS is necessarily the problem. I'm saying that blue hydrogen could be the problem, right? And I think I highlighted that it's because green hydrogen is very competitive, or will be competitive with blue hydrogen, right? So green hydrogen is a direct competitor to blue hydrogen. The IRA significantly favors green, and there are some questions, and this is debatable. This is actually a very lively debate as to whether blue hydrogen is environmentally sound from a from a greenhouse gas point of view. But yeah.
Okay, but if you look at if you look at the levelized costs of electricity, for example, produced, and you look at the costs of producing electricity now, from wind, solar, and storage, and then you look at the levelized cost of producing, say, for example, electricity through the use of coal plus CCS, or oil or gas plus CCS, and you use Lazard's levelized cost of electricity. You can almost see, look, why would anybody buy electricity at the cost of gas plus CCS when they can actually buy it at a much cheaper rate, and it's electricity. It's not like premium gasoline or anything. It doesn't make your car go faster. It's just the same stuff.
It's like same electron, as you pointed out, Simon. It's all electrons, right? It's all the same shit, if you will, right? So I mean, that's totally right. Obviously the problem with renewables is this intermittency issue, right? This dispatchable transmission problem. The wind doesn't always blow, the sun doesn't always shine. We at Carbon Tracker, we not me, but other folks have done some research showing that we can reach very high renewable energy penetration rates, right? But even at that stage, right, and I traded power before, right? And if you don't get enough power in the system, right, power prices goes ballistics, okay? Because you're going to risk a blackout in the economy, and blackout will be disastrous in so many different ways, right? So you need energy storage, and that's where potentially CCS can come in. That's where batteries will come in. That's where hydrogen can come in. Dispatchable power, intermittency is a very big issue that you need to deal with ultimately.
Okay. Look, Neil, thank you. Look, we're at 50 minutes now. We've got a couple of questions that we haven't gone on unanswered, and we have the names, and we will follow up with you. But first of all, thank you, Neil, for a great presentation. Thank you to our behind the scenes team, Kerry and Evgenia, who have been listening quietly in the background and have made the webinar technically possible. And lastly, thank you to the audience for spending your valuable time with us, and we hope that you found this useful. And if you are, and you do have follow-up questions, Neil's email address there is on the screen. Do feel free to follow up with Neil. But thank you for joining, and have a very good rest of your day wherever you are.
Yeah, thank you all, guys. Thanks for joining.